If money were to disappear tomorrow, it wouldn't happen with a loud collapse, but through a silent, gradual erosion. Most people would only grasp what was happening after it was already too late. The first signs would look like ordinary inconveniences rather than a great catastrophe. ATMs limiting withdrawals, bank transfers delayed for security reasons, an unexpected announcement that certain banknotes will be exchanged or withdrawn from circulation. History shows that financial collapses rarely arrive with a single dramatic event. They come as a process. This is a chain reaction in which trust disappears before the currency itself does. When trust is gone, money is nothing more than pieces of paper and numbers on a screen. We have lived through this scenario many times, from ancient empires to modern nations in developed and developing economies alike. The real question is not whether it will happen again, but whether we will recognize it in time to protect ourselves. To understand what it means for money to disappear, we must first understand what money actually is. Money is not the coins in your pocket or the numbers in your bank account. At its core, money is a shared belief, a collective acceptance that this symbol, whether metal, paper, or digital, can be exchanged for goods and services. When that belief is strong, a single banknote can mobilize armies, feed cities, and raise monumental structures. When that belief cracks, no law, no government decree, no central bank intervention can repair it quickly. This truth was the same in the Roman Empire as it was in early 21st century Zimbabwe. Rome's collapse did not happen only on battlefields. It began in the mints, as silver coins were gradually debased by mixing in increasing amounts of base metals. Eventually, those coins became little more than ordinary pieces of metal. Bakers, no longer trusting the coinage, began to demand payment in kind: wheat, olive oil, even chickens. Once money lost its function as a store of value, the empire's economy unraveled. Look at Weimar Germany after the First World War. Inflation spiraled out of control to absurd levels. In 1923, prices were doubling every few days. People were paid twice a day so they could spend their wages before they lost value. Million-mark banknotes became worthless before they even reached a pocket. Wheelbarrows full of cash were needed to buy a loaf of bread. Money had not physically disappeared. The place it truly vanished was in people's minds. Once belief in the currency dissolved, the financial system collapsed, and all the wealth that was thought to be stored evaporated in an instant. During Zimbabwe's hyperinflation in the 2000s, the state printed $100 trillion banknotes. The number is so extreme it sounds comical, yet it could barely cover a few days of basic shopping. These banknotes eventually became souvenirs in the hands of foreign collectors. They gained value not as money, but as curiosities. In Venezuela, conditions deteriorated to the point where people cut hair in exchange for food or smuggled goods across borders. The common thread in all these examples is the same. When the financial structure collapses, people turn to whatever they can still trust: gold, everyday goods, foreign currencies, anything except the national currency. If something like this were to happen tomorrow in a major economy, say the United States or the European Union, the effects would be instantly global. Supply chains stretching thousands of kilometers rely on trust and instant payments. When money stops functioning, ports seize up, shipping halts, and supermarket shelves empty within days. International agreements denominated in that currency become void overnight. Digital transactions, the arteries of modern finance, come to a standstill if banks freeze accounts to prevent a run. This shock is not only economic. It creates a deep psychological trauma. For generations, people have assumed their accounts are safe, their salaries will be paid, their pensions will be there. When that assumption collapses, panic begins. History shows that when money collapses, people lose not only wealth but the basic structure of daily life. Trade stops, trust evaporates, and the gap between those who are prepared and those who are not becomes brutally clear. In ancient times, this meant a return to barter economies and local systems. Today, it means a turn toward alternative stores of value. In Argentina's repeated crises, the U.S. dollar became a parallel currency. In 1990s Russia, as the ruble collapsed, foreign currency and tangible goods created a second economy. Today, after banking turbulence, many see cryptocurrencies as an escape route, a decentralized, borderless way to preserve value. But we should not idealize crypto as a savior. If money were to vanish completely, crypto would face its own problems. It depends on electricity, the internet, and functioning platforms, things that could fail in a true systemic collapse. Still, it would certainly play a role. We have already seen Bitcoin act as an emergency store of value during local crises. In countries with capital controls, crypto has been vital for moving wealth abroad. Yet, in a global monetary collapse, it would be only one element in a complex survival equation. Gold, on the other hand, is the oldest asset to survive the death of currencies. From ancient Egypt to today's central banks, it has always been a last resort, universally recognized and impossible to print at will. During the collapse of the Soviet Union, gold jewelry and coins were used in exchange for food and aid. During the Great Depression, as banks failed, those who held gold had an advantage when cash was scarce. But gold, too, has drawbacks. It is heavy, difficult to transport in large quantities, and easily confiscated by panicked governments. The U.S. ban on private gold ownership and forced confiscation in the 1930s was no accident. In a crisis, the rules can change overnight. What would the first days and weeks after money disappears look like? First, complete chaos. A rush on grocery stores for basic food, rationing at gas stations, or outright refusal of the old currency. Small-scale barter networks emerge. A mechanic trades repairs for food, a farmer trades vegetables for medicine. Communities build microeconomies based on trust and tangible goods. The black market explodes, not only for illegal items, but for everyday necessities like baby formula or batteries. Those with real wealth, not bank digits, but assets with intrinsic value, adapt the fastest. Over time, a new medium of exchange emerges, and not necessarily one issued by the state. In history, private banks or large companies have issued their own accepted notes. Sometimes a foreign currency takes over completely. In 1990s Yugoslavia, the German mark became the de facto money in many places. Today, a technology giant could create a stable digital currency backed by real assets and outpace governments. This is precisely why central banks are rushing to develop their own digital currencies. If they lose control of the medium of exchange, they lose power. That is the core of the issue. Money and power are inseparable. Whoever controls the currency controls the economy and society. When money disappears, that power fragments. The race to replace it shapes the new order. In Rome, the army and local leaders filled the vacuum. Today, institutions like the IMF impose conditions in exchange for rescue packages. In the future, states, corporations, and decentralized networks may compete side by side. For individuals, the lesson history teaches is crystal clear. If your wealth exists only within the system, it does not truly belong to you. Deposits, stocks, bonds, all are claims that can be frozen, devalued, or erased. Real wealth is diversified, tangible, and resilient. It can be physical assets, skills that others need, or trust networks outside the formal system. Those who preserve their freedom through monetary collapse are never the ones who blindly trust the system. They are the ones who understand that the system is only as strong as public belief, and that belief can vanish overnight. If money disappeared tomorrow, most people would still wake up thinking everything was normal until they try to buy bread, fill their tank, or pay rent. The smart ones notice the signs early: rising debt, inflation that outpaces wages, central banks losing control, political turmoil, eroding trust. The role of the financial historian, my role, is to show you these signs before it is too late. Because history does not only tell us that money can disappear, it shows exactly how it disappears and what remains standing when it does. The greatest irony is this: once everything settles, once a new order rises from the ashes, those who preserved real wealth will see that the world has been reset, that the game has begun again with new rules, new winners, and the same unchanging human nature. If this text has made you see the fragility of the financial system differently, don't just read it and move on. Rethink what wealth means in your own life. If the numbers in your account vanished overnight, what would you still have that could be traded, produced, or held with real value? Because money is, in the end, an idea. And if the idea dies, you'll want something tangible in your hands. Prepare now,